What's up guys, welcome back to InvestingPH. Now for this video, I'll share with you the top performing stocks in my portfolio. These are the stocks that lifted my portfolio even with all the bad decisions I've made throughout my investing journey since 2019. For starters, my portfolio's annualized return is 8.02% since inception, most of which actually comes from dividends, since that is my main strategy as I am a dividend investor. This is in comparison to the Philippine market, which is still down big from its point in 2019. So for the first two stocks, this too has quite a small percentage in my portfolio, but it is worth mentioning as these two hold the third and fourth place for the highest returns, giving me a 68.4% return for Shang Properties, and China Bank gave me 66.6% return. This is with dividends, by the way. For Shang, I've held the stock for an average of 2.34 years. And China Bank for 3.04 years. These two are the second and the third smallest of my holdings. You may ask why I wasn't able to add more to it. Well, as I rely on my monthly salary for my investment and the price went up suddenly, it exceeded my buy price for it quickly. If you look at how this company is doing, Shang's earnings have recovered well after the pandemic. Though its price has climbed drastically, its dividend yield still sits at 7.5%. And with a comfortable payout ratio of only 13%. They have historically grown their dividends, and for its valuation, P/E ratio is still the lowest out of its peers. Why? Because of course, their earnings increased exponentially as well, which led to it catching up to its price. And the price to book is still way below, only at 0.4, so even with its price climbing up, it's still undervalued when you look at its price valuations. For China Bank, earnings as well have steadily grown, not even being affected by the pandemic. Dividends still sit at a good 5.5% yield and a low payout ratio of 14%, which means they can easily maintain their payout, historically increase their dividends as well, and still also has a low price to book ratio of only 0.7. So the meaning of this, you are buying 1 peso of their equity for only 0.7 pesos. That's why a PB ratio below 1 is considered undervalued. That's why both stocks are still in my portfolio, as even with a price increase, the company is still quite undervalued, and since it's giving me a consistent growing dividends as well, I am good holding it for a long time. So what are my new buy price for the two? For China Bank, my computed intrinsic value is 50.64. With a 30% margin of safety, my buy price is 35.45, and for Shang, my computed intrinsic value is 5.13%, and with the same margin of safety, my buy price is 3.59. So Shang is still trading near my buy price as of the creation of this video, and when I computed the intrinsic value, I didn't use their average earnings growth as it was too high, so I just used the industry average when I computed it to give me a more conservative buy price. The next one is LTG, a holding company engaged in banking, tobacco, distilled spirits, property, etc. Now, though not that high compared to the two, it gave me a total of 39.1% gain. For an average holding period of 2.39 years, almost all of the gains I've got from LTG came from dividends, so this will just keep increasing and increasing exponentially over the years. This is the second largest holding in my portfolio, currently taking up 8.4%. If you look at how well LTG is doing financially, revenue and earnings have progressively grown over the years. This is even with the tax imposed on their tobacco business. Their other businesses have offset the effects of it, especially their banking business, PNB. Their dividends stand at 11.7% with a very low payout ratio of 6%. This is why the company can easily maintain their dividends. Over the years, they have grown their dividends as well. As of now, the price of LTG has stayed very low, with its P/E ratio only 4.4. Compared to the other holding companies, it's still below the average. The same as for their price to book of only 0.5. With how much dividends I'm getting from the company, I can see I would be able to get an ROI from my investment in less than 8 years as I compound all of those dividends even if the stock price stays stagnant. For my buy price, my updated intrinsic value is 13.58, and with a 30% margin of safety, my buy below price is 9.5. Next up is Aboitiz Power, engaged in power generation and distribution. Total gains is 50.37%. For an average holding period of 3.5 years. This is the 7th largest in my portfolio in terms of market value and the 11th in terms of invested capital. The same thing for their earnings and revenue has progressively grown over 10 years, while recovered past their pre-pandemic level. Dividends, even with the price going up, still sit at 6.4%, and with a payout ratio of 51%. Though this is high compared to the other companies I've shown, what I look at is at least a payout ratio below 60% is a good percentage for me. Though their dividends decreased during the pandemic, this is a given as power companies were affected a lot during those times, but now they've recovered and have given record high dividends. For its PE ratio, it's still quite low, only at 7.9, though the price to book is at 1.4, meaning for every 1 peso of equity, you're buying it at 1.4 pesos. As for my buy price for AB, computed intrinsic value is 50.06, with a 30% margin of safety. Buy price is 35.04. So the price today is slightly above it. If the price falls below it, I would definitely add more to it, as I want to increase further my investments in this company. Now, just a quick break. If you're curious as to where all of these data are coming from, well, this is from Simply Wall Street. I can't exaggerate enough how helpful this platform is for me, as it has really simplified my investing journey. I get updates from the stock in my watch list, from dividends, insider buying or selling, earnings release, and when the stock falls below its intrinsic value. Yes, they also compute that for you if you don't know how. And if you're analyzing companies, well, the way they present it is so easy to understand as they show graphs, and my favorite part of it is their portfolio tracker. With this, I can easily know the health and performance of my portfolio, and there's more in store for you. So if you want to try it out, they offer their basic plan forever free. But if you want to sign up to get unlimited access to all the tools and filters, you can do so using my link below and you can get up to 50% discount. What are you waiting for? Try out Simply Wall Street. Next up is Metrobank. For an average holding period of 2.11 years, gave me a return of 62.25%. This is the third largest in market value in my portfolio and ninth in invested capital. The banking segment over the past 2 years has recovered well. So is Metrobank, booking record high earnings, and they're continuously growing their equity over the years. Dividends is still 6.8% even after the price climbed, with a comfortable 30% payout ratio. And these past years, they've increased the dividends they paid out exponentially. Price to book is still quite undervalued at 0.9. Now for banks, what I look at is their price to book, as this for me is better to evaluate banks. As for my buy price, the computed intrinsic value is 89.06 and my buy price is 62.34. So Metrobank's price right now is quite overvalued based on my computation. Now, the second highest gain I have in my portfolio is also in the banking industry, is AUB. With an average holding period of 2.28 years, it gave me a 75.99% return. This is the 5th largest in my portfolio in terms of market value and the 13th for invested capital. AUB's earnings have grown exponentially over the last 2 years. The same goes for their equity. Maybe this is the reason why their stock price has appreciated so much, as their performance has been so strong. Dividends still sit at a good percentage of 5% with only an 18% payout ratio, and AUB has increased its payout as well. For its price to book, even though its stock price has increased, their price to book is only 0.6. You will notice the banking sector still has a lot of undervalued stocks in terms of their price to book. For my intrinsic value computation, it's at 60.41 with a buy price of 42.29. And the last and the highest gain in my portfolio is DMCI, giving me a 199.05% return. This is with an average holding period of 3.64 years. Right now, this is the 6th largest in terms of market value, but the 17th in terms of invested capital, so it climbed to be the 6th largest in my portfolio because of its price appreciation. DMCI is a holding company engaged in construction, coal, nickel mining, power generation, real estate, water, and manufacturing. They benefited well during the pandemic. This can be seen in their earnings, which booked record high earnings in 2022. However, it has decreased in 2023 due to volatility in their coal business, which is their largest holding semi-rara. As for their balance sheet, well, the company is still in a good position as their debts are well managed. Equity has consistently grown over the years. For its dividends, its yield sits at 12.3% with a good payout ratio of only 30%. Dividends have been stable and have grown over the past years. As for its valuations, P/E ratio is at 7.6, well in line with its peers, and price book at 1.4, so in terms of PB ratio, it is quite overvalued compared to the other holding companies. For my computed intrinsic value, it's at 11.49, and with a 30% MOS, it's 8.04. So its price is way beyond my buy price. That's why I haven't added more investments to this company for quite a long time, as the price went up so fast. With that, these are the top performing companies in my portfolio. So for a dividend investor, even with most of these companies' stock price has considerably gone up, its dividend yield is still quite high. And with how well these companies are, I know they will continuously grow over the years. That's why these are the companies I invest in. I don't just focus on the dividend yield alone. I focus on investing in strong companies that give consistent dividends and are trading at a fair price. And the best thing about it is, if the stock price doesn't go up after I bought it, at least I'm still getting dividends as I wait. So with that said, I hope you've learned something from this video, and if it did and still haven't clicked the like button, I'd appreciate it if you do so before leaving. Thank you and see you in the next video.